big question heading into earnings season was how much more the big tech firms could spend on artificial intelligence. The answer? A lot. Microsoft, Meta, Amazon, and Alphabet alone guided to over $600 billion in capital expenditures for 2026 to support their accelerating build-out of infrastructure for AI. Despite this spending, each of the firms indicated they expect to remain compute capacity constrained going forward. Our opinion is this spending makes sense given the size of the opportunity. However, investor responses were mixed as this level of investment is likely to consume the majority of these firms' free cash flows, both changing the nature of these companies from high-margin asset-light businesses to asset-heavier ones and limiting the scope for material stock buybacks. On the subject of AI, you may have heard more chatter lately about coding products that are intuitive for even non-coders. The product that's gained the most mindshare so far is Claude Code from Anthropic. As users, we can attest that it's an extremely powerful tool. For coding professionals, models like Claude Code and ChatGPT's Codex are radically transforming their workflows to the point where many say they no longer write any lines of code at all, only guiding and reviewing code generated by the models. Moreover, these models are beginning to exhibit signs of recursive self-improvement, and the cadence of model updates has ticked up noticeably over the last few months. In our opinion, productivity going forward will only be limited by creativity and individual agency. That said, it's clear that models like Claude will pose disruptive risks for wide swaths of the white-collar economy, especially for firms and workers that are slow to adapt. Likewise, real-world models like Google's Genie 3 are also rapidly improving. These models, which enable users to map out realistic interactions with real or imagined physical settings, are key to unlocking the promise of self-driving vehicles, automated manufacturing, and industrial robotics. A year ago, such models could barely render a few seconds of low-quality footage. Take a look at what I was able to generate in just under a minute this morning using Genie 3. Now, in a few years, perhaps I'll not just be able to imagine a scene from a classic Western movie, I'll be able to create an entire film. Given the accelerating improvements in AI models, the main story in markets has been the sell-off in software stocks. Since the fall, the iShares software ETF IGV has declined 30%, with much of that coming in the past few weeks, as investors have fretted, understandably so, over the implications of improving coding models. To be clear, we don't think the average firm will decide to replace its software suite with its own coding projects in Claude. Beyond the issues of core competency, there are issues of compliance, security, reliability, and maintenance. That said, there is a risk that even if a small percentage of firms creates their own bespoke software, it will hit pricing power for the overall software sector. Further, we'd expect competition among software firms themselves who are best placed to make use of new AI capabilities to heat up, leading to further pressure on features and pricing. In the future, as models diffuse more across the economy, there's a risk of job losses that could upend the per-seat licensing model of many software firms. In short, what's happening is that firms who are priced for perpetual growth are now pricing in plateauing growth, and in some cases decline. Again, we do think that much of the market reaction is justifiable. That said, the selling has been indiscriminate, and there are some firms amidst this downturn that we're closely reviewing for potential new investments. Finally, in a world where the path to artificial general intelligence seems like a pending eventuality, what assets are relatively safe and at risk? For the last 20 years, asset-light tech firms have had an incredible run. Asset-heavy firms, on the other hand, think energy, industrials, and manufacturing, have underperformed on a relative basis. As we've discussed, AI may upend this. Firms working in the physical realm that make tangible products and goods are far less susceptible to disruption risk than firms working in the digital one. If anything, asset-heavy firms may ultimately stand to benefit most if AI unlocks cost-saving efficiencies. To be sure, we don't think every type of tech firm is in trouble. The AI companies, compute infrastructure firms, consumer tech, and cybersecurity, to name a few, are well placed. We're just highlighting the relative opportunity in traditional capital-intensive firms versus those that were capital light. And if the world ultimately does run on AI, the firms that make that physically possible stand to benefit. Please let us know if you have any questions and have a great week.